If you look at tech stocks, what are people really worried about? Is it the fact that actually they don't know how to price earnings? Is it the fact that they're concerned about regulation? What exactly is going on?
So I don't think from a fundamental perspective there is much that is, going wrong at the moment. When you look at earnings, when you look at forward earnings, when you look at realized earnings, things look pretty much in order. Also, when you look at valuations, or you look at relative valuation versus MSCI World or versus the S&P, for example, actually it doesn't look like there is an awful lot going wrong. Right? But I think that's where exactly I think you're right in saying, look, investors have a really tough time pricing it because they don't know how to price data breach scandals. They don't know how to price these kind of idiosyncratic risks, which all come together. And I think that's really very, very difficult to translate into price action, into valuation, into earnings estimates. Okay, but so what does that, so it could actually mean that the sell-off is completely overdone? It could mean that, but I think so. I'm getting slightly scared with regard to tech right now, because when you look at some of the important factor indices, some of the classic factor indices like quality, or you got like something like growth indices, or you got something like momentum indices, they all have about 35 to 40% in tech right now. The market cap weight is about 17%. So that's the problem there is, right? Of course, if we do have momentum selling off further, if we have cyclical selling off further, then also tech will suffer further. So I think really the fate of equity markets right now, also the fate of the bull market right now, is heavily connected with tech right now.
Andrew Balls, I want to jump into an idea of how all of this bond market links in with what central banks will do. And we can go to Mr. Draghi, but instead let's go to Mr. Your tie looks beautiful, Andrew. You're just styling it today with that tie. Let's go to Jerome Powell and the Fed. Bring up the dots, if you would. I was away for the Fed meeting. Thank you to Scarlett Fu and Mike McKee and all for just a great Fed coverage a few days ago. Well, guess what, folks? The market and the dots are right on top of each other for now. And then, Andrew Balls, it changes. And this gap, to me, I'm sorry, out 2 years, the gap is still substantial. How far is this market from this Fed 18 months or 2 years out?
So the Fed has told us last week that they expect to go restrictive over time. When you look at their long dot and where they expect to be 2 years out, they're signaling that they expect to be going restrictive versus the neutral rate. We'll have to see. The market clearly is lower. There's a lot of uncertainty in the outlook, as always. Particular concern about inflation. We think that there's plenty of room for the market to build in some more tightening by the Fed, but overall, the front end of the curve looks quite reasonable.